4,808 is the highest point the S&P 500 has ever reached, and prior to the pandemic, it had only ever surpassed 3,380 points, meaning that in the span of only 2 years, the S&P 500 has grown by approximately $12 trillion. Now that is a lot of this stuff, and what if I told you that since the beginning of the pandemic, the stock market has changed by quite a bit more than just through massive inflows of capital. Rather, the past 2 years have materially changed the American economy, and in turn will undoubtedly have impacts on the stock market movements in the decade to come. You see, the stock market crash of 2020 was the quickest recession from peak to trough in history, followed with the quickest stock market recovery at only 6 months. And with it came the insane euphoria of the stay-at-home economy, as well as companies poised to change the world through disruptive innovation. What's even more staggering are the millions of new investors that poured into the American stock market in early 2020, and with them came trillions of new dollars being injected into the equity markets, which has led to one of the largest wealth accelerants in modern history for a select few individuals. In fact, the wealth of US billionaires surged by an astonishing 70%, equivalent to $2.1 trillion over the course of the pandemic, fully resulting from public equity values skyrocketing and their combined $5 trillion held across 745 billionaires is more than the $3 trillion held by the bottom 50% of the US population. And while the media was enamored by the likes of GameStop, Dogecoin, and so-called pandemic stocks like Zoom, Zillow, and Cathy Wood's ARK funds, well, in the shadows, a great shift to the US economy as well as US stock market emerged, securing even more of a monopoly for a select few mega cap companies. Hey everyone, it's Griffin here, and by the time you're watching this, it's probably New Year's Day, so I just want to take a quick second here to thank every single one of you who tune into my channel, watch my videos, and drop a like every once in a while. Thank you very much and Happy New Year. So let's get right back into the video though, starting with the great accelerant of US tech firms. Alright, so both the economy and the stock market have changed quite a bit over the past 2 years, and with it came some major shifts in consumer buying patterns for certain industries, really giving them that extra push needed to pick up further momentum, notably in the e-commerce, digital advertising, and digital currency spaces. E-commerce, for example, is one of these industries that has truly benefited the most. And if we take a look at the data of US e-com sales over the past several years, it kind of looks like Elon Musk tweeted about it in Q1 2020. I mean, realistically though, I guess that's what happens when the government shuts down brick and mortar, forces people to stay at home and shop online, and plops a check on their lap every single month. In reality though, what the pandemic has done is really just further accelerated the already increasing dominance of a select handful of companies on our everyday lives, which is probably going to continue for the foreseeable future, and this has also been clearly reflected over into the American stock market. This has very well become a case of the strong get stronger, where there's been a significant rise to dominance of a small subset of American companies that have completely outperformed and outdone all other firms over the course of the pandemic, being big tech. These top companies that make up the S&P 500 have gained such a large competitive advantage and monopoly over the rest of the market, with cash piles so large that they can bully any other company that stands in their way, and a true grasp on our everyday lives that make their momentum really difficult to stop at this point. Of course, the companies I'm speaking about here include Apple, Amazon, Microsoft, Facebook, as well as Google. And you might be wondering, well, how and why have these companies been able to gain so much power and momentum? And the answer comes down to featureization and a product flywheel. A what? Yeah, I'm not talking about insects here, I'm talking about a business flywheel, which is a self-reinforcing loop made out of a few key initiatives. And those initiatives feed and are in turn driven by each other, and therefore will build a long-term self-sustaining business. Amazon, for example, has the holy grail of all business flywheels, where Prime attracts shoppers who want a wide assortment of products and rapid fulfillment, and every initiative they take feeds into another, as we can see from this diagram. Oh, and let's not forget about featureization, where these top companies like Amazon and Apple have taken entire industries and transformed them into a feature of their global business. Back to Amazon quickly, they turned the entire shipping and delivery industry, once dominated by the likes of FedEx as well as UPS, into a product feature with Amazon Prime, offering free 2-day shipping on all the goods and services pretty much on their platform, as well as access to Prime streaming, where you can access world-leading entertainment all in the same package. And you guessed it, this further transforms and turns their flywheel, making it spin even faster than a hamster on an exercise wheel. And just take a second to think about how powerful this is, that a company that has over 151 million active Prime accounts has almost full market penetration in the US. In fact, that is more active Prime accounts than entire US households. And in the case of Apple being the largest company on the entire planet, they have also featurized an entire industry, being the wearables industry with their watches as well as their AirPods, which, if this was spun off into its own company, would be one of the top 20th largest companies on the entire planet with annual revenues of over $20 billion. All right, sure, Griffin, you convinced us that these top companies, they're going to continue paying for their founders' childhood space exploration dreams, but how does this apply to me? Are we going to see a stock crash or something? Well, whether or not we're going to be seeing a stock market crash in the coming years, ultimately no one really knows. But what is a fact is that the top 10 companies that make up the S&P 500 index have eclipsed the other 490 companies over the course of the past 2 years in terms of adding value to their market cap. In fact, these top 10 companies now make up more than 27% of the entire market index. And when comparing their growth to that of the entire S&P 500, the growth and weight discrepancy becomes clearly visible. And what's even more striking is that since the early 2000s, the top 10 companies that make up the index have not only changed many times over, but have also drastically changed industries, now favoring once again big tech. And these top 10 companies make up a much larger percentage of the entire index itself, especially since around 2016. Okay, but what about the underlying valuation of these companies, also known as the PE ratio, where the S&P 500 is known right now for having a very high relative price to earnings ratio? Well, do keep in mind that just because the trailing 12-month price to earnings ratio of the S&P 500 remains quite high, well, when we take a look at the forward-looking PE ratio, we can see that it has remained quite constant over the past 2 years, ever since the values shot up initially. Now, this is because these companies are expected to continue posting monumental growth figures in terms of their net income, which they have been doing over the past couple of quarters and are expected to continue doing so over the next year. Some investors, though, might be quick to compare what's currently going on right now to the early 2000s and fear that there might be a bubble on the horizon, which for the record may be the case, but there definitely are some major differences between back then and what's going on now. First and foremost, the early 2000s was a very different time period where tech wasn't nearly as well known as it is right now, and thousands of so-called tech companies with literally no financially strong underlying business were trading on exchanges and raising venture capital like never before through multiple financing rounds at increasing valuations. And to put this into perspective, between 1996 and 2016, the amount of new US IPOs has dropped by 88%. So in this light, the tech bubble of the early 2000s was actually spread out across thousands of so-called tech companies, and these typically made technology infrastructure that other companies ended up using. Whereas now in the modern era, the majority of this big tech is concentrated in 5 or 6 companies really that are completely dominating and expanding into multiple different industries and product verticals. But even having said that, we did somewhat experience this type of early 2000s euphoria near the beginning of 2021 with startups as well as so-called innovative companies, where their valuations reached euphoria and all-time highs in February of 2021, which is what I've coined now as the Cathy Woods era. And a large majority of these companies have since corrected enormously. I'm looking at Zillow, Teladoc, as well as other companies. But the big tech companies here, being the big 5 that we've been speaking about over the course of this video, have just continued gaining more and more momentum over the course of the past year, to the point where now they have so much momentum, they're like a runaway train. Now, I know what you're probably thinking though. Right now, with higher levels of inflation and moving into 2022, well, aren't we expected to see interest rates increase over the course of the next year? And won't that also have a negative repercussion and impact on the valuation of these companies, especially growth stocks as well as tech stocks? So to answer this concisely though, well, yes, typically speaking, when there's higher levels of inflation like we're seeing right now, moving forward, there will be increases in interest rates, which is the plan for 2022. And usually this does have negative repercussions and impacts on companies that are labeled as growth stocks, as well as companies that have or need to use a lot of debt in order to further finance the growth of their operations. So in this light, any company that is very low on cash reserves and needs to continue using debt to further grow their operations is probably going to be seeing a bumpy ride over the course of next year. And the market has definitely realized this and is starting to already price all of these factors in to market price points, as well as rotating funds into other sectors that tend to hold up better during periods of higher interest rates, like for example, energy as well as bank stocks. That being said, the top 5 big tech stocks being Apple, Amazon, Microsoft, Facebook, and Google hold a staggering $650 billion worth of cash and short-term investments, representing 23% of the entire S&P 500's cash reserves. And of course, this could be used for further reinvestment and growth or share buybacks, all of which would be positive for the market value of their stock. So all this to say, there's no denying the fact that the economy and in turn the stock market have shifted quite a lot over the course of only the past 2 years and continue to beat records that multiple people never thought possible. But whether or not this time will be different is definitely hard to say at this point. What is certain though is that as retail investors continuously investing into the broad market funds like the S&P 500, the Nasdaq 100, or even the total stock market is a surefire way to continue growing your wealth over time. Again, this is something that I try to do as much as possible. Usually on a weekly basis, I purchase multiple different index funds as well as some strong stocks that I personally believe in for the long term as well as their dividend. Now, if you're looking to start investing in the stock market yourself, make sure to check out the links down below to different stock market resources and brokerages that I recommend, and you'll get some free money for signing up, like $25 with Wealthsimple Trade if you're Canadian, as well as 3 free stocks if you're American and you sign up with Moomoo. And of course, moving into the new year here, if you're really looking to take hold of your finances and your stock market investing, then of course, I would recommend that you take a look down below at the full stock market investing course that I have, where you can get everything you need to know to properly navigate the stock market and create a portfolio suitable for your needs as an investor. So on that note, thanks a lot for watching, and I will see you in the next one.